Welcome back. You're sitting at your desk, it's the middle of June, and a coworker just told you their health insurance was cut off because the company changed plans. Your heart starts racing. Can your employer just drop you whenever they feel like it? The answer is complicated. But here's the truth they don't want you to know. Your employer does have a surprising amount of power to change your health plan mid-year. But they also have strict legal boundaries they must follow. Cross one line, and you have real rights. Today, we're going to sort out the facts from the US to the UK to Canada so you can understand your rights and never be caught off guard. First, let's look at what the law actually says. We're going to focus on the US because that's where the rules are the most complex. Then we'll explore how our friends in the UK and Canada are protected. In the United States, the rules for your health plan come from a powerful piece of legislation called the Employee Retirement Income Security Act, or ERISA. This federal law sets the minimum standards for most private employer health plans. One of its key provisions is that once you elect coverage, you are generally locked in until the next open enrollment period. You cannot simply change your mind unless you experience a qualifying event. As industry experts explain, employees can only change or cancel coverage mid-year if they experience a qualifying change in election event, including, and then they list things like getting married, having a baby, or losing other coverage. It is a two-way street. But does this mean your employer is also locked in? The answer is yes, but the employer has a lot more leverage. Here is where most people get confused. Your employer has a powerful tool called a Section 125 cafeteria plan. This is the legal framework that allows them to take your premiums out of your paycheck pre-tax. Because the IRS is involved, the rules are strict. Financial hardship is not considered a valid reason to drop your coverage mid-year. A 2026 summary from a benefits firm states that a Section 125 plan may not provide leeway for an employee to drop their pre-tax elections mid-plan year due to financial hardship. Your employer is obligated to follow the plan's rules for everyone equally. If your company's financial situation changes, they have more options, but they can't just target you. However, the biggest question most people have is this: can your employer drop your insurance entirely? Yes, but there are severe penalties. Under the Affordable Care Act, employers with 50 or more full-time employees are generally required to offer affordable coverage that meets minimum value. If they drop it for everyone, they face major financial penalties. But they cannot just drop you as an individual. That could be seen as a form of discrimination. However, they can change the plan's benefits or the carrier at any time. If they do, you have to be notified. Experts note that employers must provide 60 days advance notice for any material modification that occurs mid-year, including changes to employer contributions towards premiums. If you have a major medical event and your employer changes the plan mid-year to reduce your benefits, you could have a legal claim against them. Now, let's move to the UK, where the situation is fundamentally different. In the UK, the law does not require employers to provide private health insurance at all. It is considered a discretionary benefit. Your employer can typically decide to stop providing it to everyone, as long as the change is applied equally and included in your contract's terms. But if it is a contractual benefit, they cannot simply take it away from you as an individual unless you breach your contract. If you leave your job, the insurance almost always ends. As one guide notes, when you switch roles or leave an employer, your company private medical insurance, PMI, usually ends on your leaving date or soon after. However, you usually have the right to convert the policy to an individual plan and keep your medical history coverage. known as continued personal medical exclusions. But that's a different story. In Canada, the rules are a mix. Your core medical care is covered by your provincial health plan, like OHIP in Ontario or MSP in British Columbia. You cannot lose that coverage just because you lose your job. As one Canadian source explains, your provincial health plan, like OHIP, MSP, or AHCIP, will remain active regardless of your employment status. You are safe for that. But your employer's extended health benefits, like prescriptions, dental, and vision, are at risk. Your employer can end those for everyone, and they likely end for you when you leave. But provincial laws protect you from discrimination. If the change is substantial, it must obtain your consent, meaning your employer cannot unilaterally downgrade your specific benefits without your agreement if it's a term of your contract. Now that we have the rules, let's talk about what happens when the worst-case scenario becomes real. Your employer drops your plan. What do you do next? You have powerful options. Your first lifeline is a law called COBRA. For most employers in the U.S., if your job ends or your hours are cut, or if your employer simply cancels the plan for everyone, you have the right to continue your group coverage for a period of time, usually 18 to 36 months. You must pay the full premium plus a small admin fee, which can be expensive, but it keeps your exact same coverage. Your employer has a legal duty to notify you. If they cancel your insurance without telling you, employers are legally required to notify employees if their benefits are canceled, especially when premiums are still being deducted from paychecks. If they don't, the government can intervene and get your rights reinstated retroactively. Your second powerful tool is the Special Enrollment Period, or SEP. The loss of your employer-sponsored coverage is a qualifying life event. This opens a special 60-day window for you to enroll in a new plan on the Affordable Care Act marketplace. You can also use this period to enroll in a spouse's plan. This ensures you never have a gap in coverage. Let's wrap this up with the key takeaways you need to remember. Number 1. In the U.S., your employer generally cannot drop you as an individual mid-year without cause, but they can change the plan for everyone if they give proper notice. Number 2. If you leave or lose your job, COBRA allows you to keep the same coverage for up to 18 months, but you'll have to pay the full cost. Number 3. Losing your job-based coverage triggers a 60-day special enrollment period, which is your chance to find an affordable plan on the marketplace or join a spouse's plan. Number 4. In the UK, private health insurance is a benefit, not a right. It usually ends when you leave your job, but you can often convert it to an individual plan. Number 5. In Canada, your provincial health card is always safe. You'll never lose your core medical coverage, but your employer can end your extended benefits for everyone. Number 6. In all 3 countries, your employer must communicate material changes to your benefits. If they don't, you likely have a legal claim. If this video helped you understand your rights, hit the like button. It helps more people avoid getting caught off guard by their benefits, SATA scores, and turn on notifications so you don't miss my next video, where I'll share exactly how to negotiate the best possible severance package, including health benefits, before you sign that final document. And comment below, have you ever had your employer change your health plan mid-year without warning you? Share your story and what you did about it. I read every single comment. Thanks for watching. Now go check your employee handbook. See you in the next one.